Hello and good afternoon, good day to you all. Thank you very much for taking time out of your day to tune into this webinar from Natural Capital Partners, title being We Are Still In, and taking inspiration from much of the conversation in the buzz around New York Climate Week a week before last. So just a couple of housekeeping things. This webinar is scheduled to last for an hour, and we'll leave about 15 minutes at the end for questions. We have 4 terrific speakers who will set the scene, actually go into some of the detail. Now, you're all muted and in listen-only mode for this webinar, so please use the panel on the right side of the screen to submit any questions, which we'll get to at the end. Thank you. So let me introduce myself. I'm Jonathan Shopley, on the left of this lineup from Natural Capital Partners, and it's a real pleasure to have 4 people on our panel today, people that we've gotten to know well over the years. A very brief introduction from me: Jeff Cohen, co-founder of Xpansiv. But Jeff, we've really known one another through the work that you did in setting up and establishing EOS Climate, which I know you're going to speak about, but really one of the most effective and innovative offset methodologies and operations around, and you'll explain why. Jeff, you're going to be followed by Jessica Orrego, and Jessica, we too have known one another actually before your current role as Director of Forestry at the American Carbon Registry. But in your role at the ACR, we're going to get some insights from you around what's going on in the forestry sector, and we've always admired ACR in this space for the deep technical work you do and the innovative work that you've done to bring climate finance to both the voluntary and the regulated markets in the US. And then Peter Bake. Peter, you've got a seat as professor at Arizona State University, and you cover 2 very admirable disciplines, School of Sustainability and the Cronkite School of Journalism. And some people, I'm sure, will know you as a filmmaker that's really participated or communicated, I would say, very effectively in the area of soil sequestration, and that's what you're going to speak about today. And then finally, our lineup will end with Tim, your perspectives in what is a fairly newly minted role in the Edison Energy team. We've known Tim for many years as a member of our advisory forum to the Natural Capital Partners company, and also in the work that you did engaging business when you were at C2ES, Center for Climate and Energy Solutions. So that's our lineup for this afternoon, and what I'd like to do is just to make a couple of framing opening remarks. Next slide, please. So the whole, picking up on the theme of the webinar, business really has gone from waiting for action, wanting action, and now taking action, very much embodied by the We Are Still In campaign. But this all started back with the science, the IPCC's first report in 1990, and then of course the establishment of the UNFCCC's framework for climate Convention for Climate Change, and then that led by 2005 to the Kyoto Protocol, which ran and was unsuccessful in renewing itself in 2009 in Copenhagen. But then in Paris a couple of years ago, we got the Paris Agreement, which will kick in 2020. So the political process has sort of picked up off of the science. But when we started looking at what's been motivating business, organizations like CDP, Carbon Disclosure Project, as it used to be known, and more recently the Task Force for Climate-Related Financial Disclosures have really brought to market the requirement for a little more transparency, or a lot more transparency, around how companies are preparing for the risks and the opportunities in climate change. And then we've had a sort of a next generation of alliances like We Mean Business and the Carbon Pricing Leadership Coalition, which have really gathered businesses wanting to take action and given it something of a sharper point than it's had in the past. And then we have initiatives like RE100 set off by the Climate Group, in which over 100 organizations have committed to 100% renewable energy by certain target dates. And the science-based targets, an interesting coalition of WRI, WWF, CDP, and the UN Global Compact, reaching back into the science set off by the IPCC in 1990 and refreshed on a 5-yearly basis, to encourage companies to take on science-based targets for their internal reductions. And then somewhat to the side, or over that, the UN's global goals for sustainable development, which provides a real wider framework for action on climate change against 17 of these goals. And what that means is, as we move to action, as represented by We Are Still In, it feels to me that what I'm reminded of is actually this, if you could believe it, a map, which is a stick chart actually used by Marshall Islands navigators in the South Pacific. And the sticks here represent currents, and the little white dots are corals that represent islands. And this seems to me about a good sort of analogy of where business is at. These are choppy waters. We've got politics, and we've got science, and we've got business, and we've got finance, and the disclosure sectors, all bringing quite a lot of energy to the system, but it's quite hard to navigate your way through to actionable programs. And that really sets us up for this webinar. The 4 speakers that we've lined up are really have been involved and are involved in activities centered in the United States that afford businesses tremendous opportunities to take action. So without any further ado, I'd like to hand over to you, Jeff, just to talk about the things that you as EOS and of course now as Xpansiv are doing in the climate space to help businesses take action.
Hi everybody. Thank you, Jonathan, for that very nice introduction. Really good background on what we're doing here today. Just so you know, I'm not seeing the slides, so I'm flying a little bit blind. I will hopefully be synced up with everybody, and hopefully everyone can see my slides. Just picking up on Jonathan's remarks, I'm going to be talking about how businesses can take advantage of carbon markets and other more conventional markets, particularly commodities, and the work that we're doing to enable that. So next slide, and I'm assuming the next slide will be EOS Climate on top. We were started out of a MBA program in Presidio Graduate School in San Francisco. We were created to develop with our focus was market-based solutions to reduce emissions of fluorochemicals, including refrigerants, and we will talk about them in a little bit of detail right now. And if you go to the next slide, refrigerant management was identified of all the 100 substantive solutions that Project Drawdown analyzed to address climate change over the next 30 years. Refrigerant management was ranked #1 as the most important, impactful opportunity. Refrigerant management refers to leak avoidance, end-of-life management, both things that we've been involved with over the last several years. And the estimate was that over the next 30 years, 89 billion tons of CO2 equivalent could be prevented by deploying technologies and infrastructure that already exist, but in many cases have very high costs, and there's a lack of financial incentives to properly manage these gases. So if you go to the next slide, that's where carbon crediting comes in to enable, unleash financial incentives that really aren't there now. I'll be talking about this chart. I'll go back to this chart several times, but it looks a bit like alphabet soup here, but the groupings are important because each class of refrigerant is regulated and managed in different ways depending on what they do. The common thread across all these refrigerants is that they're used in across the economy for refrigeration, air conditioning, and built environment, motor vehicles, for processing, storing, transporting food. They're really critical, obviously, to our way of life. Diverse industrial processes, pharmaceutical, chemical production, oil refining, etc. Data servers, and most refrigeration and air conditioning equipment over the last 50 years or so have relied on fluorochemical refrigerants. The top two, CFCs and HCFCs, are both ozone-depleting chemicals, which is that second column, and they are both regulated under the Montreal Protocol. CFCs were phased out of production in the 90s in the developed world, and HCFCs are now being phased out of production around the world as well. So if we go to the next slide, these ozone-depleting chemicals, if we're on looking at ODS destruction protocol, we created a greenhouse gas carbon crediting protocol that's been adopted by the California Cap and Trade Program. That protocol has resulted in north of 11 million tons of carbon credits, or tons of CO2 equivalent, being prevented, and that credit type has been really instrumental in helping to get the California Cap and Trade Program in a cost-effective state, and has helped finance transition to next-generation technologies. Next slide. Back to this chart. HFCs have gotten a lot of press over the last couple of years. They are the so-called ozone-friendly substitutes for CFCs, and the reason they've gotten a lot of press is that although they're ozone-friendly, they also have very high global warming potentials. You can see in the third column in the several thousand range. The Montreal Protocol parties agreed to a gradual phase down starting in 2019 that will continue over the next 20, 30 years around the world. So what can we do in between? And what we came up with was another type of, if you go to the next slide, another type of offset methodology for HFCs that was developed in partnership with ACR, the American Carbon Registry, and published in 2015. And this gives crediting for reclamation and reusing HFC refrigerants that would otherwise be probably not managed properly at end of life. So if you go to the next slide. Reclaiming, we estimate 30% of HFC refrigerants would prevent something on the order of 18 gigatons of emissions through 2040. And manufacturers of new refrigeration and air conditioning equipment can participate in this program and negate or offset the carbon footprint of their new HFC-based systems. And businesses relying on refrigeration or air conditioning can retire these credits against their HFC targets. If you go to the next slide, we're back on the chart looking at HFOs, which are hydrofluoroolefins and natural refrigerants. And these are the substitutes for the substitutes. These are very low or zero climate impact refrigerants that are being deployed in some cases quite slowly. And we came up with another protocol, another methodology in the next slide to incentivize installation of advanced commercial refrigeration. If you go to the next slide, there's a picture of a supermarket case, and supermarkets and other facilities that are installing refrigeration equipment can generate credits using this new ACR methodology that we developed. So I'll leave it there on refrigerants and look forward to questions, but I wanted to transition to what we're doing in our new company, where our focus is on commodities, the raw materials at the base of global supply chains. And we came to this as an outgrowth of our work on offsets, where we were really doing, we created a national production model to deal with end-of-life equipment and end-of-life refrigerants. And we realized a lot of what we were doing could be applied to other materials. And what we have tried to do is address the misalignment between markets and desired scientific outcomes when it comes to commodities. And what do I mean by that? If you go to the next slide, not all commodities are created equal. So depending on where and how something is grown or harvested or extracted, there can be significant differences in how much energy, water, fertilizer, etc. are used in producing the same material. And commodities represent something on the order of 40% of annual global greenhouse gas emissions associated just with commodity production. And commodities are commingled, obviously, around the world in markets. So they create risk for businesses and investors that are sometimes opaque. The slide here shows that crude oil, depending on where it's produced, has a much different carbon footprint, and the attributes associated with each unit of crude oil can be digitized and quantified and digitized, and that's basically what we're doing with our new platform. If you go to the next slide, Xpansiv Data Systems was created to differentiate low-impact commodities for global markets. We're working extensively with a large group of partners, including sustainability standards, reporting bodies, NGOs, and various businesses. We have a comprehensive report that we published on the impact of technological evolution on post-Paris markets for the World Bank as well. Our initial applications are in these three categories: natural gas, renewable fuels, and some agricultural products. The next slide, I may have skipped a slide there, the natural gas proof of concept. We're collecting data from about 4,500, it's close to 5,000 natural gas wells in the US. We're quantifying the methane leakage from point of extraction to initial sale at the well pad based on real-time production data. The data and the digitized versions of the gas is being loaded onto a blockchain where the data is transferred and transacted on our platform, and it's enabling low methane producers to expand their market based on the unique profile of their production. If you go to the next slide, which is the last slide, where our platform is generating digital feedstock from virtually any source of commodity production. And I think actually one more slide, apologize Rosie, market functionality. We think that this will enable producers to more efficiently engage with existing markets. It will allow marketers to automate manual processes, increase accuracy for new trading strategies, and we think that downstream market participants will be able to better source their supply while reducing risks with more transparency. So with that, I will get it back to Jonathan. I appreciate it.
Hi, Jeff, thank you very much indeed for that. And without further ado, I'm just going to hand on the microphone and the presentation over to you, Jessica.
Thank you, Jonathan, and hello, everyone, and thank you to the organizers of the webinar. I'm happy to be here. Today I'm going to change gears a little and talk about opportunities for U.S. forestry and grasslands in the carbon market. Next slide, please. So just a little background on who we are. ACR, or the American Carbon Registry, is part of Winrock International. Winrock is a nonprofit organization that was formed in 1985 by 3 Rockefeller family organizations. Winrock is dedicated to economic development and resource management in the U.S. and around the world. We place a strong emphasis on climate change and adaptation and environmental markets. ACR was the first private voluntary greenhouse gas registry, and it became part of Winrock in 2007. To date, ACR has issued over 100 million tons of greenhouse gas emission reductions. And in terms of what we do, what a registry does, our activities include developing and approving carbon offset methodologies and standards, overseeing project verifications, and reviewing and registering offset projects, including issuance of serialized offsets. Also, just worth noting that in 2012, ACR became one of the approved offset project registries under the California offset program, under their cap and trade program. Next slide, please. So this is a list of all of the land-based offset project types that are approved under ACR and applicable to the U.S. This list does not include project types like the refrigerant methodology that Jeff just spoke about. Since today I'm just focusing on the land-based project types, but if we wanted to include the non-land-based, this list would be much longer. We have lots of non-forestry and non-land-based methodologies and project types. So for each of these project types, for each of these approved methodologies, there is an approved or almost approved quantification methodology, and that enables project developers to estimate the project baseline, so the counterfactual baseline, to calculate emission reductions, and also to establish monitoring procedures that can all then be packaged up in documentation and verified by third-party auditors. And then this results in issued emission reductions that can be sold into the voluntary carbon market. At the bottom, I also note that the ones with an asterisk, those project types are also permissible under the California cap and trade, but the quantification and requirements are slightly different in that program. Next slide, please. Okay, so diving into more detail about why carbon offsetting represents an opportunity for forests and grasslands in the U.S. So you'll see that 33% of all U.S. land area is forested. So that comprises 766 million acres of forest land in this country. In that area of land, 43 billion tons of carbon is stored. So that's just a huge amount of carbon. Forest cover, forests aren't threatened in the way that they are in other places where deforestation rates are very high. But forest cover in the United States, while stable, is changing in terms of health and age class distribution, and also management is not always sustainable. Those rules change state to state. Further, the U.S. population is growing, so sustaining our forests for both ecological and economic reasons is more and more crucial. So moving over to grasslands, 30% of the U.S. land area is covered with grasslands. That comprises around 700 million acres, and it represents about 5 billion tons of stored carbon. Unlike forestry, grasslands are rather threatened. Right now, in the last 5 years, I think about over 1 million acres have been lost per year due to conversion over to agriculture. For example, the Conservation Reserve Program, or the CRP, which is a program where farmers enroll to receive payments in exchange for keeping their environmentally sensitive grasslands out of agricultural production, enrollment is declining on an annual basis. Avoided grassland conversion is a project type currently permissible in the voluntary carbon market, including the American Carbon Registry. But so far, it's kind of in its incipient stages. Only around 300,000 acres have been enrolled. But what's clear to us is that that's a very important sector where growth is needed, and I think there's a lot of potential there. Next slide, please. So going back to forestry, this slide really just highlights the overall impact that the California Cap and Trade program has had on U.S. forestry. And I just want to highlight that, not that we're talking too much about the California program here, but just the kind of impact that an offset program can have. Under the program, improved forest management is one of the eligible project types. Between 2013 and 2015, owners of 6 million acres received more than $1 billion in carbon revenue for adopting sustainable forest management practices for 100 years. That is what is required under the California Offset Program rules. In 2018, compliance carbon revenue to landowners will exceed the Forest Legacy Program. The Forest Legacy Program is a federal program that partners with states to encourage acquisition of easements, of conservation easements that require sustainable forestry practices and also protecting other values. That program to date has, the revenue has been just under $1 billion. It includes just 2.6 million acres, and that's been in place since 1990, and that's actually a very successful program. It's just here for comparison to see the overall impact that the California program has had. If you look at just the 10 largest forest projects alone in the California program, they comprise 1.4 million acres, and 70 projects in total, forestry projects in total, have registered under the California program and cover over 6 million acres. And the revenue from the carbon sales has, in many cases, actually changed the way some large landowners, including industrial landowners, manage their timber, because that price just tips them over the edge to enable them to manage for timber in a more sustainable manner. So cut less and adhere to the California rules. So to me, this really demonstrates that carbon pricing can really have a significant impact on the way natural resources are managed across millions of acres. Next slide, please. So this is my final slide, and I'm just going to close by saying that I'll reiterate that offset markets really can have a significant benefit. In this case, I'm talking about grasslands and forests, and that includes sustainable management and conservation and also other environmental benefits and values. The voluntary market is an incubator and a test bed for innovation. It really always has been, and I'm sure it will continue to be. And the projects can deliver high-quality offsets to corporations and governments and private buyers that wish to take climate action. However, expanding the benefits does require buy-in and then, of course, finance and support. Thanks so much.
Jessica, thank you. That was great. I'm just going to give everybody, all the attendees, a reminder about questions. If you just type them in and send them through to us, we are going to have some time at the end. So if you do have a question, pop it over. And then I am going to hand over to you, Peter, to pick up on a presentation that I know will build in some way on what Jessica has covered. Over to you.
Hello, it's a pleasure to be here. My name is Peter Bick, and I'm a filmmaker and a professor of practice at Arizona State. And you can see here that we have a large team of scientists, and we're studying adaptive multi-paddock grazing. It's a type of grazing that really hasn't been studied, and there's a gap in the science, and we want to help start that, filling that gap. And our main question is, can adaptive multi-paddock grazing improve the land, the farmer's income, and draw down CO2 at scale? And so next slide, please. So what we're going to do is we're going to compare AMP grazing with conventional grazing. And AMP grazing, in a nutshell, basically mimics the way herds of bison moved across the Great Plains. And what they do is they have an area where they hit it really hard with their hooves, which stimulates seed growth, and then they fertilize it with the manure and urine. And they're there for a short period of time. They don't graze down to the surface of the soil. A lot of times they'll just graze about half of it. And then in the old days, from predation, wolves and such, they would move on, and then that land would get a long rest period. And it's that heavy hit and rest that the way the grasslands and the animals evolved, and it's what stimulates basically the soil system to come alive and photosynthesis to really pump, and the wildlife benefits, and so do we. And so carbon is the currency in the system, and we'll be studying a lot of different metrics. We'll be studying soil carbon and how long it's going to stay in the soil and which pools of carbon. We'll be studying the microbial communities, bacteria and fungi. We'll be studying the greenhouse gases cycling in and out. We'll be studying the biodiversity and the nutrient level of the forage that's being produced above and below ground. We'll be studying all the insects above and below ground. We'll be studying the birds and wildlife indicators. We'll be studying the health of the animals. We'll be studying the rancher well-being, their finances. We'll be studying their resilience. We'll be doing life cycle assessments for all the farms and ranches we're studying to understand all the inputs coming in and all the inputs going out, so we can really assess the carbon footprint and all the other greenhouse gases, methane, nitrous oxide, CO2. We'll be modeling, and then my specific part of this team is the filmmaking part, and that's also I'm leading the charge for fundraising. Next slide, please. So the global carbon stocks in gigatons, and this is carbon, not CO2. You can see that the oceans are the giant, but what a lot of people don't know, and I certainly didn't know it, is that soils are the next pool of carbon. And within the soils, about 350 gigatons are in the soils worldwide. And that's 3.5 billion hectares of grazing land around the world. And so that's it's a significant number. And we'll go to the next slide, please. And so the emissions on an annual basis, we put up about 8.9 gigatons of carbon per year through everything we do as humans, cities, farms, everything. The oceans are absorbing about 2.3 gigatons. Land systems from forests to agriculture are right now absorbing 2.6, and we think it could be more. And the atmosphere is taking in 4 gigatons of carbon annually, and that's obviously up to 75% of what's warming the Earth right now. Next slide, please. And so if we look at that 3.5 gigatons a year, well, hold on one sec. If we look at increasing the pasture soil carbon by 1% and all 3.5 billion hectares of grazing, that would equal 3.5 gigatons of carbon annually. And if we look at that number and look at what's up in the atmosphere, 4.0, you could see that that's a very close number. Now, getting 1% on all grazing land around the world is not going to happen, but it's a back of the envelope number to show a potential scale of grazing lands. And one of the papers that Dr. Richard Teague was on our science team, he studied Texas ranches for a decade, and he quantified 3 tons of carbon per hectare per year more, which was about 3% increase. So we've seen 3% increase. We've got early data that's showing 2%, early data that's showing 4%. But the science that we're talking about is really, we want to understand this better. We want to do it in the southeast U.S. We want to do it in the upper Great Plains, cool, dry, and warm and wet, and see what the differences are, if there are any differences. And again, that's between AMP grazing and conventional grazing, right across the fence, same soil type, same slope to the sun, as much apples to apples as possible. So the only difference is a fence and an owner. Next slide, please. So what we do see right now with AMP grazing is we see a lot of benefits, and these are things that we see pretty much on every ranch and farm that's doing these methods. We're seeing incredible water resilience. They're able to absorb much more water in a rain event than their neighbors, meaning that they're having effective rainfall. Every drop of rain that's landing on their land is staying on their land versus washing away. And when water washes away in a big rain event, it's also washing away your soil. But these folks have all their soil covered with plants, so they're not losing that soil, which is reducing erosion a huge amount, which is actually, both of those things are making them great neighbors for anyone downstream where they're not getting a lot of soil in the water and they're not getting a lot of flooding. The biodiversity on these places is increased quite a bit from their neighbors and from what they had when they started, from wildlife above and below ground. And the food itself, we'll be partnering with folks who are going to be studying this specifically, but the food quality, the animal quality, the forage quality, we're seeing increases, but we need to see a lot more science there. And the one thing that we're seeing consistently is improved farm economics for the farmers and ranchers who are doing these methods, and that to me is the gold standard. It's good business. And it's good business, therefore we have a shot at getting this adopted at a high rate. But of course, as one of my partners says, we're dealing with people, and just like I don't want to change from anything I do, including my editing software, a lot of farmers and ranchers don't want to change the way they're farming and ranching. So getting that change is definitely going to be a big part of moving into the future as we scale this up. Next slide, please. So can AMP grazing be adopted quickly? So these are the enablers we see, that there's a lot of land available, and this is grassland. This isn't land that would be used for farming. This is land that is grassland. And the technology is available. We're seeing the farmers and ranchers, they're innovating consistently, but what they're doing is pretty fascinating. Their OpEx is better for the ranch economics. The supply chain, if they continue to if they raise the animals on grass till it's finished, there's a bottleneck there on a couple different issues with getting grass finished beef to market. Some of our farmers send their animals to feedlots, and some of our farmers finish to grass. So we're seeing both of those things. The soil biology, can it hold a lot more carbon? And that's what the science is all about. And how long will it last? That's what the science is all about. We see carbon pools that last days, that last decades, that last centuries, and that last millennia. So we know soil carbon can last a long time. It's a question of will it. And then, like I said earlier, consumers, well, what I said earlier about the farmers, about 1% of US farmers are practicing regenerative grazing right now. The consumer demand is growing astronomically, but it started very small, so the numbers aren't huge yet, but they're certainly going in the direction of up in a very steep curve. Next slide, please. So what we're talking about is we're talking about closing the carbon cycle by using the carbon cycle. So if you imagine, you know, we borrowed the carbon, we've used the energy from the carbon, we have our society, we have our life, we emit it, and then wouldn't it be neat if we could return it and have all the benefits of that carbon going into the soil where it's actually quite beneficial versus staying in the atmosphere where it's now detrimental. Obviously we want some up there, but not as much as we've got. Next slide, please. And so we're in the funding stage right now. We are going to hit the spring research window, which is huge for us. McDonald's is on board for $4.5 million. We've just had a foundation come on board for $1.25, but we haven't made that public yet, so you're just seeing the word foundation. And so we're going to start in the spring of 2018, and we'll be reporting out fall of 2019. We're going to continue this work. It'll be for a few years after that as well. And that was my last bit. Thank you.
Peter, thank you very much for that, and thank you for a couple of people who've been putting some questions our way, don't forget. Tim, you've got some heavy lifting to do, given that we've had 3 presentations primarily focused on carbon finance and you know, mitigation, and so over to you to talk a little bit or shine a light on the renewable energy part of the market.
Thanks, Jonathan. And yes, I'm going to bring us up a couple of levels to talk about the renewables market and what we've been seeing. I think this webinar shows the huge landscape of potential solutions to climate change, which is what it's going to take to get the kind of reductions that we need to get. As Jonathan mentioned in the introduction, I'm the Director of Corporate Engagement and Sustainability here at Edison Energy. I work on the Renewable Energy Advisory Team, which some of you may recognize under the old name of Altenex. I came here after 10 years working on climate change in the nonprofit sector at the Pew Center on Global Climate Change and later the Center for Climate and Energy Solutions. And 10 years plus on climate policy can make you quite a pessimist, particularly in this country. And my wife will tell you that, and probably most of my friends and all of my family, that I'm a born cynic. So it's hard sometimes to be an optimist. But I've also worked with the corporate community for the past decade. And as Jonathan mentioned up front, with all that's going on, that can make you more of an optimist. Next slide, please. And like Jonathan, I was up in New York City a couple of weeks ago for the annual Climate Week that the Climate Group puts on at the same time as the UN General Assembly meeting. So you get not only some really first-rate New York City gridlock, but also an incredible range of events. And one of them was the launch of this Climate Optimist campaign, saying, and their tagline is that solving climate change starts with the belief that we can, right? And so I got to thinking about that, and it's a matter of overcoming my cynicism when I think that we already basically know how to decarbonize over 2/3 of our global economy. We electrify the majority of transportation, and we decarbonize the electric sector. We have the technology to do that already, but to get there, we're going to need to radically scale up renewables, which is why I decided to join Edison Energy. Next slide, please. I'd been spending 10 years on policy, and the idea of actually, joining a company where we're going out and helping this transition happen bigger, better, and faster was incredibly enticing to me. And as a company, we have worked with a large portion of the Fortune 50, the Fortune 500. We've now done over 2 gigawatts of off-site renewables procurement, but also worked with companies on-site as well, and working on their renewable and sustainability strategies. And you can see a number of our clients below. Next slide, please. We'll talk a bit more about our process in a couple of minutes, but I wanted to first quickly run through a few slides that demonstrate why I'm a renewables optimist. You can clearly see here the trends over the past decade globally, and even though these numbers are fairly flat at a high level for the past few years, with a rapid decline of solar and wind costs, you're actually seeing greater capacity increases with the same level of investment. Ironically, the China is red on this slide, but you can see the massive growth in China over the last few years. And those who follow climate policy will also know that China is actually getting ready to institute a emissions trading system this year. So don't let anybody tell you that China isn't doing anything. Next slide, please. You also see the massive growth in the US in the last decade. You have 24x growth in wind, and 56x growth in solar in just the last 6 years. Next slide, please. And why are you seeing that? Especially on the solar, you can see the rapidly declining price of solar. Both from 1976 through the beginning of the century, but then that decline continuing rapidly over the last 15 years. Next slide, please. And so what is all this leading to? Bloomberg New Energy Finance, which is a fantastic resource for these types of predictions. They've taken a look at where we were in 2016 and where we think we'll be in 2040, and you'll see they're expecting that coal and gas is going to get halved in terms of global capacity from 54 to 27%, while the total installed capacity more than doubles, with renewables taking up that slack. That's going to be a tremendous difference in the next 25 years. Next slide, please. So how is all this translating into the corporate sector? Well, the answer is really amazingly well, and it's rapidly increasing. 48% of the Fortune 500 have set some type of greenhouse gas and sustainability targets. 71% of the Fortune 500 have done so. If my math is correct, I think that's 71 companies. And many of these companies have set science-based targets. I'm on the technical advisory group of the Science-Based Targets Initiative, and 2 years ago they said that they hoped in 2020 to have 250 companies signed up to SBTs. I thought that was a total pipe dream. But I was not enough of a climate optimist. We're now at 305 companies, including a good number of Fortune 500s, and they're now averaging 2+ a week joining. So that means that by 2020, we should more than double that goal. Next slide, please. 70 companies have now signed up to the WWF-WRI Renewables Buyers Principles, as you can see here. And again, it's not just a group of small, earthy, crunchy companies. Next slide. And you've got now over 100 that have committed to using 100% renewable energy. And this logo slide is actually a little bit old now. So, we're seeing a rapid increase in those commitments. Next slide, please. And here you'll see how these trends are translating into the corporate purchasing of renewables through long-term contracts. And they're doing it because they want to manage risk, their reputation, for cost reasons, and of course to help meet their sustainability targets. So the declining costs in the sector and the increasing commitment to climate and sustainability will see these trends continue. Next slide, please. And here you'll see a list of many of the long-term contracts that have been signed over the last few years. And again, Edison has advised on over 2 gigawatts of these, and that's equivalent to over 20 new coal plants. So you can see why I'm excited. Next slide, please. So what do we do to move this forward even faster? What are the challenges? Well, in what we see in our clients is the challenge of getting internal alignment, the lack of independent analysis, how to look at contract structures that may be completely new, and limited internal resources, and that's why it's helpful to have an advisor. Next slide, please. It's also helpful because the marketplace is massive, as you'll see on the next slide. There are over 5,000 projects in the U.S. at any given time, as you can see on this map. Yellow being solar, the gray being wind. And so how do you make sense of that? You know, we have a supply team that is now 7 people who that's all they do is interact with the developer community. We recently ran an RFP for a client and got 538 responses. That's a full electoral college worth of responses. And how would an individual company deal with that alone? You know, so next slide. You know, so we work with our clients through a very time-tested process of internal education, running that competitive process externally, project selection and negotiation, and figuring out what the company's risk tolerance and profile is, and what their other criteria are. What do they want to look at? How do they want to think about the impact they're having and additionality? Next slide. So, you know, we have a number of resources that you can find on edisonenergy.com, including a number of case studies, including the Home Depot, General Motors, Iron Mountain, 3 of our clients, a market report that we put out 2 times a year that looks at the whole market for renewables in the U.S. And then other thought leadership pieces such as additionality, which we're working on and we'll be getting out in the next few weeks, which is increasingly important to companies. So with that, I'll leave it there and say that I've become more of an optimist over my year here, and I hope this presentation made you feel the same. Jonathan.
Tim, thank you very much. So we've got optimism meets science meets technology, and we've also got, and thank you really for a tour de force there. And we really have a range of questions, and we're not going to be able to deal with all of those in 10 minutes. So what I've done is I've looked at those that have come in, and there's some that are quite technical, and we'll probably take those offline, so all questions are going to be answered. But in the time that we've got left, here's what I'm going to ask you to do. One of the questions that I thought spoke very much to the title of our webinar, and Tim, you've sort of picked up a little bit on this, is how will any of the mentioned solutions reach the "we are still in" signatories? And so I think what I'm going to do with the remaining time is I'm going to go down the panel again, or across the panel again, and ask you to sort of think, you know, respond to that question. And I think, you know, behind that is what question should people be asking when they make companies make a statement that we are still in, we want to move from waiting through to action. In some respects, each one of you have talked about products, about services, but what question would you ask of a company that's thinking, I've signed up to we are still in, I really feel committed to understanding the risks and the opportunities to take action? And then how do they interact with the thing, or you know, connect with the kinds of solutions that you've spoken about? So that's the single question I'm going to ask all of you. I'm going to give you a minute each, a minute and a half actually, otherwise we won't be able to end on time. And then just starting again with you, Jeff, if you could kick us off.
Okay. Yeah, the work we're doing is really designed to give companies who are making these commitments a mechanism and actionable outcomes that they can do today to reduce their carbon footprint and really mobilize investments towards a low carbon or decarbonized economy. So the work we're doing with natural gas, for example, and the blockchain platform, for those companies who are not able to transition to renewables in part or in whole, and are relying on the grid or relying on natural gas procurement directly, the work the platform that we've developed is really for companies that can differentiate low methane natural gas, for example, and make procurement strategies really focused on minimizing the impact of natural gas. And the same for refrigeration, air conditioning. There's thousands of companies that use refrigeration and in large facilities. By purchasing the offsets that we talked about, gives them an opportunity to directly reduce their footprint in an organic way. So I'll pass it back.
Thank you, Jeff. That's wonderful. And Jessica, passing straight on to you.
Sure, Jonathan, thanks. Yeah, I mean, I don't want to sound too redundant, but, one thing that's always been ironic to me is that if we hadn't pulled out of Paris, it wouldn't really have been very hard for the United States to meet our NDC or our commitments under Paris, and, I guess there still could be an opening to stay in. Between RGGI in California and initiatives that will eventually turn into legislation in Oregon and already in Washington State, there is so much going on to reduce emissions on the compliance side, and through that there's the innovation of offset project types and quantification methodologies. So that's already happening, and so anyone who, the signatories, if we are still in, can simply connect to those innovators and already invest in offsetting. And then of course there's the other side of all of the activities that Tim just mentioned, all of the businesses that are getting involved in renewable energy and other initiatives. So, I mean, I think that there's just a lot happening regardless of whether we are in or out of Paris, and I just think it's a matter of connecting the dots.
Another great optimist statement. Thank you, Jessica. Peter, passing on to you.
Yeah, if I understand the question correctly, is what do I ask companies when I'm dealing with them? Do you really know how to close your carbon loop? Is what you're focused upon science-based? Is it affordable? Is it making the world better and not just less bad? And lastly, would you brag about it to your kids or your grandkids, whatever you're doing? That's it.
Thank you, Peter. Very concise and very helpful. Tim, you've got the final word on the panel. I know you've covered quite a bit of what Edison Energy offers. The whole concept, all the things that we've talked about have been related to market-based approaches in some way, shape, or form, particularly when we talk about renewable energy instruments and offsets. Any sense of a view of how that will play out into the future under the Paris Agreement for those who are still in that and those countries which are not within that?
Well, and of course, pretty much the entire world is still in, and for the time being, the United States actually is too. We can't pull out for several years, even if they started the process. So, our parent company, Edison International, signed. We're still in when it first came out, and we. Part of our company is a utility, so actually, has skin in the game, and that I think shows the number of companies that have signed on to that. Show that this is really an unstoppable movement. It's going to take a lot to get from here to there, but as I mentioned, renewables is going to be a critical part of it, and all the companies that are working on market-based solutions and working on science-based targets really won't be able to get there without thinking about renewables. In terms of the future of Paris and global markets, once China comes on board, Europe already is, California, a bunch of Canada, you're going to have, over half of the world, 60% of the world, working on carbon markets. So I think that's inevitable too. It's not happening nearly as fast as we hoped or as needed, but there is reason for optimism, and I agree. We should all look back and say, are we able to brag to our kids, or in my case, my nieces and nephews? And I hope that we all can.
Tim, thank you so much, and thank you all for your presentations, for the timely way in which you presented a real wealth of information, and I think we've gone some way towards answering the question about, for those who are still in, what are the actionable things that can be done by corporations. Thank you very much for that, and thank you all for attending. Just about to close this, I just wanted to say one last time that the questions that we've got, we will respond to those if they weren't covered by my general catch-all. And on the screen now, you've got contact mails for each of the speakers, and if you have specific things that you'd like to put to them, please feel free to be in touch with us all. And with that, again, my sincere thanks to both panelists and the participants. We're closing the webinar now. Here's wishing all you optimists the very best.